I'm heading the European department at Union, European Investment Department. We're also doing the sales across Europe. And within this department, we have two teams. So we are covering Germany, Austria, Switzerland. This is one team. The other team covers the rest of Europe. We have included the UK into the European department against the trend, so to say. And basically, we are active mainly in the office segment and mixed-use properties, while we have specialized departments covering hospitality and retail globally. So I can mainly speak for the office markets. And we are pretty active across all these markets. We have purchased in secondary city in Poland. This year we've exchanged contracts on a major investment in the city of London. We are looking at another one right now. We've recently purchased in Paris, and we are active even in smaller peripheral markets, because for Union it's always a mix. We have to be active in the liquid hubs, so we always will allocate a majority of our capital in Germany. This is due to the funds profiles, and this is also the toughest job to do these days, because our home market is becoming very, very competitive, as you already explained, Fabian. And basically for us, it's a mix between main and peripheral markets. We are moving up the risk curve. We're taking development risk increasingly. We are forward funding a lot of projects, and we are looking at alternative sectors like micro-living, student housing. For the first time, we are starting on the residential sector in Germany through a affiliated company where we acquired a minority stake in ZBE this year, and they're labeling a residential fund for us. So we're active in most asset classes, apart from nursing homes, which we didn't really ever look at.
Okay, or maybe not yet.
Maybe not yet, but well.
Good, thanks. Sascha.
Hello?
Should do.
Should, yeah, okay.
Yeah.
My name is Sascha Wilhelm. I'm CEO of CORESTATE Capital Group. CORESTATE is an investment management business, so no real estate on our own balance sheet, but managing external equity. In real estate, we have 16 billion of assets under management now, with the takeover of Hannover Leasing by mid of this year. Where are the real estate markets and asset classes that we are active? We're active 80% in Germany. We've grown the business with value-add opportunistic residential, entered into the retail secondary markets 2 years ago, are active in the micro-living segment, meaning student accommodation, very early mover there since 6 years already. We have added business travelers to that segment, so the micro-living segment, where we are active in Germany, in Austria, Switzerland, and in Spain. And with the takeover of Hannover Leasing, we are now in the office segment as well, across, in addition to Germany, the Benelux countries. And a very small proportion of the whole assets under management is in the aviation business, but I think that's not the topic for today.
Do another one on aviation. Alex.
Thank you, Sascha. So I'm Alexander Eggert. I'm with Warburg-HIH. So we just do real estate, no aviation, no ships. HIH Group is in 15-point-something billion investment management company, just doing real estate investments for institutional investors. We are pan-European invested. Our, I think, focus is on office on one hand and retail properties on the other hand. Our main customers, or let's say the main sources of capital, are German institutionals, so we are very German on the capital side, and pan-European on the property or real estate side.
Great, Jan.
I got my own mic. Hello. Good morning, everyone. Again, Petersen. Yeah, Apleona GmbH, fund management. It says Apleona, the former name, which was Breifiing Real Estate. We were taken over by Eggert, the facility services and real estate unit from Apleona. So we are supporting the life cycle of the every real estate, mainly in office buildings for sure. And even if the life cycle is over, we start restructuring, revitalizing, and starting from scratch. I'm heading the asset management and the fund management all over Germany. Within the fund management, we have approx 150 fund management companies, being not AFM compliant. It's the old world kind of, so there we are very much busy in opportunistic and value add properties. We love to revitalize it, and on the other hand, active for institutional investors. And 50% of our business is GBA in UK, so, and the rest is continental Europe. So looking forward to the conference. Thank you.
Christian Bischoff, CEO, founder of Log4Real. We're a development company for logistics and light industrial real estate. We normally partner up with big equity providers and do core market developments in logistic real estate. We're active in Germany, of course, in Austria and Benelux and in Sweden, and looking into market structures in Poland and the Czech Republic. Yeah, we are leveraging, of course, on the nice market environment since a few years, and hope to leverage for another few years on it. And for logistics, we are now looking also into light industrial, which is becoming more and more popular. Now there are two approaches. One, you have old warehouses and try to make them new, or you build a logistics type of warehouse and fit it out with production environment. We're doing the latter and try to be near to the big cities, metropole areas. That is fun, and on the other hand, you always have to explain why you come with so much trucks to the neighborhoods, and so. But from an investment point of view, we're happy to have our core market and our home market in Germany, as we see very much interest on equity coming into Germany and trying to do a business here.
Great, Didier.
I'm Didier Unglik. I'm the chairman of L'Etoile Properties. We are an independent investment manager. We are present in Germany, in France, in Spain, in Holland, and in the UK, and now also surprisingly in Seoul, in South Korea. We basically purchase, manage, asset management and property management properties for institutional investors all over the place. We do everything in-house, which is a bit special. Today we have more or less 6 billion euros under management, and we keep expanding with investors, using the appetite of the investors for all the European market.
Let's just start with you, Martin. Macroeconomic picture we've already heard here from Fabian that it's looking stable. What's your view? Increased slight tick up in growth. Not a huge amount of chance of significant interest raises, maybe a little bit quarter point in the UK perhaps. Do you think that that's going to, irrespective of the cycle in a way, continue to bring more capital into real estate generally as an asset class?
So I guess there is already a waiting list because so much capital has been collected already and needs to be allocated to real estate that even if interest rates would move out in the near future, and there is a home view at Union that this might be the case over the next 1-2 years, that we might at least see a slight pickup. I believe that the wall of money is so high that it will take a while for the money to be spent, and the fundamentals, as you explained, are looking good across many European markets. We are late in the cycle, but given the rental growth that we are seeing in Germany, and in some other markets like Stockholm, for instance. And already rents are picking up in the center of Paris. The cash flow side is becoming increasingly important, and there is room for further growth. So I guess that many investors will speculate on the rental cycle to continue beyond the capital market cycle, potentially. Yeah? And that could make business cases worse. But on the other hand, we have always, at this stage in a cycle, expected that the line will continue, like flatten out and continue like forever. And the unforeseen event, the black swan, has never really been anticipated. So.
No, that's unfortunately. Well, Fabian is still at Savills. It will all continue to be good. You know, that's what we know.
The line is never flat. In reality,
I mean that's interesting, Alex. In terms of the, let's say, in terms of some of the risk scenarios, you know, maybe a little uptick in interest rates. We've still got a number of the risks that were actually talked about 6 months ago, but also 12 months ago in terms of terrorism, Trump, Brexit. We've obviously had the Dutch election and now the French election that have kind of changed the mood music. But do you still see those risks, or do you just think that real estate is now beginning to be just absorb those risks really and just move on to the fundamentals?
First of all, Martin is right, we are late in the cycle, but we have a new player, so a very new, important player on the market. It's European Central Bank. So everything is a little bit linked to the difference between real estate income and income out of bonds. And the spreads are very, very high at the moment. So I think a slightly increase of interest rates would not really affect real estate markets. But to come back to your question, I think we have a lot of political uncertainty all around. At least 2 generations of European are not aware of this, so it's a new situation for European people. At the moment, I have the impression that the markets, or the real estate markets and also the financial markets, unfortunately get used to it. So we saw terrorism. We see a lot of uncertainty in France, in Netherlands, in Poland, Hungary. But markets get used to it. So it was not the external shock that might it have been. So that's the situation at the moment.
And Didier, given that you're French, but you're also looking at the other markets. Do you want to give a kind of first assessment of the impact of Macron, whether you think that would be positive, both in terms of, I guess, the stability of Europe in general, but also as an impetus to the French market?
I think Macron has got a very, very positive effect globally. I mean, if you look at the newspapers, or if you look also at the Economist, for example, over the last 5-6 issues, there were 3 issues talking only about Macron. I think he's very much liked here in Germany. He's also very much appreciated by other European countries. I believe that what he did with Trump was also very much appreciated, like going really against Trump. And the setup of the government since yesterday evening is quite positive, very much business-oriented. So it's a different spirit, and you can feel it on the street that he's trying to get everybody positive. And really going into the business orientation, not into too much politics, into too much complications, just making the country better. So that's very positive.
And are there any, when we were in Paris, what was interesting was, from the UK, everybody thought it was a very positive perspective and actually would change a number of the things about France. But actually, when we were in Paris yesterday, everybody was quite enthusiastic about it, but didn't really expect it to have a significant change in terms of investment volumes or investment appetite, really, which was quite interesting. And the view there actually was that France has actually been, Paris particularly, has been quite hot for at least 12 months beforehand, but mainly with French capital. And so maybe this might be a time for French capital to sell to the international capital, was one of the views. But also then the longer term buyers in the room said if anybody was looking to sell, they would want to buy it anyway, because they still saw that as a positive market, even though there was an expectation of yields changing again. But the only issue raised, and I'd be interested to get your point on it, was that because the turnout was 45%, that as the French have a tendency to get on the streets, and it's going to be a hot summer, that maybe it may not work as smoothly for Macron as everybody thinks. But what's your sense of that?
Yeah, there might be, most probably in September, there will be heavy demonstrations on the street, for sure, as usual. But that will be the key point. So far, all the governments over the last 15 years have always given up and accepted whatever was asked by the street, basically. And this will be the test to Macron. If he resists, and if he, like Thatcher, that would be the key. If he finally accepts to compromise, then there's no progress.
And I just wanted to pick up maybe with you, Sascha, in terms of Brexit has been one of the discussions over the last 12 months, essentially. From the perspective that you've got both here but also in the other markets that you're investing in, are you seeing any particular impact? Do you think the view has changed? Do you think there's a more positive or benign outlook at the moment? What's your sense of that?
Well, there are two points about that. Number one is how do investors see the UK and investing in the UK at the moment, and the other thing is who will potentially have positive impact from a Brexit when we talk about commercial real estate in Paris, Frankfurt, Dublin, or whatever. When we talk to, especially to investors that are making their money and are invested in the euro, and talk with them about investments in the UK at the moment, they are even more cautious than they have been before Mrs. May had that fantastic idea to go to the polls again. So they are very negative about now, because they say that with such a weak mandate that she has, no one can really say now what kind of Brexit are we going to get. Do we have a deal, or do we end up in the worst situation that capital markets and real estate investors can think about, so that you don't have a deal at the end of that negotiations at all? So what we hear from our investors, they are even more cautious when it comes to investing into the UK, as to the real estate markets there, as to Brexit, and especially in addition to that, talking about the volatility that has come up tremendously between the UK pound and the euro, and these things together make them very cautious about investing into the UK at the moment. I think this is what you can see in the numbers as well, that safe haven for the first time, number one is Germany. That has never been the case. I think London is number 27 of the cities that investors want to invest in when they think about Europe. 4 of the first 5 are in Germany, and London has come down to number 27. This is completely new. That's number one. When you ask me personally who's going to be the big winner of Brexit when we talk about commercial real estate or residential real estate, what I heard from the real estate brokerage market in Frankfurt is that there are the first real big banks, I will not mention names now, that have made not contracts, but binding reservations for great office spaces. So I do think that, at least from the banking sector, the financial industry, there is some trend to go into France. That's what I hear at the moment. The volume is a different size, but a different question. But I think Frankfurt will participate in the positive effects. Yes.
Okay, good. And Jan, you mentioned that 50% of the business was in the UK. What's your sense of that? The sense from London, which is always quite bullish generally, was that it was already at the peak of the cycle anyway, so we're not necessarily seeing purely a reaction to Brexit, but actually just the cycle moving. But obviously Brexit isn't helping. But what's your sense of that? The impact on the UK, but also winners and losers. Obviously Dublin has taken the first with JP Morgan, but is it going to be Frankfurt? Is it going to be Berlin? Is it going to be Paris? Is it going to be Luxembourg? What's your sense?
Okay, I mean, first of all, you have to consider that the Brexit was a big hit on the pound. So from that perspective, it was a big loss in our balance sheet, unfortunately in Germany. But on the other hand, as being a real estate investor, you have to consider the currency risk. I had a chat with some colleagues stating, hey, if you invest today in pound, you have to kind of leverage the exchange risk, which costs a bit of money. So that you have to take into consideration. The appetite towards UK, that's what I learned from my UK colleague, still is there. They are a bit more reserved for sure, but in UK, our unit GBA, active with approx 1,000 colleagues, is very much involved as well in urban planning, for example. So locally, developing Manchester, Birmingham, whatever, so doing huge projects, which has nothing to do now with buying, selling in the initial stage, is rather the planning, but there is still lots of movement. On the other hand, regarding winners and losers, you've mentioned Dublin, and I was last week, Thursday and Friday in Dublin, and the first thing I learned was, hey, the cranes are up and working. So there is lots of building activities at the moment in Dublin. I think they're going to be a winner, one of the winners, not the only one for sure. As you mentioned, JP Morgan went there to Dublin, but I think that some banking industry and financial industry will move to Dublin definitely. On the other hand, regarding other winners, I think in Central Europe we have first of all to recover in some countries. For example, still the Netherlands. We saw after crisis it took 5 years that we've reached break even in best city locations. Yeah, but other areas, I mean, it's crap. Yeah? It's poor. You can't bet on any increase in value in surroundings of Randstad or even Zwolle or whatever you look at in the Netherlands. I think Frankfurt will take a stake, and I hope as well Paris.
And Christian, obviously you're looking to grow a portfolio pan-European in terms of the logistics side. Logistics for the UK is kind of a different sector in a way, but has it put you off from an investment point of view, or has it put on hold any of your plans for the UK? So has it affected you as an actual investor?
Yeah, we put everything for the UK on hold, definitely. There's so much opportunity in continental Europe that we can't cope. So, I mean, the plan was to go over next year, and now we are very interested to see how costs and factors are moving. I mean, if the logistics industry should be a growth factor again in the UK, it has to become cheaper from the development perspective, and in order to play a role that is not only UK based but a little bit more, which it could. But currently, I think the winners in logistics and in light industrial are all located in continental Europe, and especially, of course, Germany by far. I'm more optimistic concerning the Netherlands, because I see that it's sort of a revival. The activities remind me of like it was in 2007. What's going on there, and land prices are getting higher and higher and higher because everybody wants to get a piece of the cake. And so I'm even more bullish in Benelux than in CE. Yeah, I must say, and it seems that the underlying trends, e-commerce, supply of goods, supply of people, are much more important than any terrorist threat and political instability and whatever. Especially in logistics, nobody gives a, you know, they were just going on. It was just going on because it's simply e-commerce is coming up so strong. It's such a strong trend that whatever happens, anybody still wants to have the CD and even food, if it's possible, ordered at noon and getting it in the afternoon. That's cool, okay? I mean, terrorist attacks, yes and no, but that's where it goes, and this is what really driving logistics and light industrial in big towns.
Good. I'm going to come to the sectors a little bit more in detail shortly. I just wanted to pick up with you, Didier, the point of the types of capital that are coming in. We're expecting there to be more capital coming in. Are you seeing, in terms of the people that you're talking to, a greater range of capital looking at either Germany or at Paris, or has Japanese money begun to come in? Is there a changeover from US to Middle East? What's your sense of the capital flows?
I mean, as far as we're concerned, we see a lot of capital coming from France for the rest of Europe, mainly because of the local REITs, the OPCI and SCPI, which are raising money like crazy. I mean, when we know that we do a lot with Amundi, and only on the retail side they raise up to 300 million every month, so they have to spend it. And it's the same for the other guys, a smaller scale, but they still raise a lot of money, and they need to spend it, and they need to diversify, so they go a bit everywhere. We have also pressure from family offices, quite a lot. That's for Europe. That's basically it. And we had quite a high pressure from South Korea, from the Koreans, to invest in Europe. They went first to the US and to Australia, but now they need to be present in Europe. So that's what we saw so far in terms of capital.
I mean, for logistics, we saw Logicor has been sold to Chinese fund. I mean, that's, if you see the size of the portfolio, if you see the transaction, and you see that really this is Chinese money. I mean, Chinese money. That's I think that's shows where money flows into Europe, and that we're much more diversified than 2-3 years ago.
Yeah, I mean, that was a huge deal coming into the market.
Over 12 billion, I believe.
12 billion, yeah. Well, that's what we reported anyway, so if that's correct. But yes, I mean, 12 billion, and also another example of somebody just coming in, which has happened a lot in the logistics sector especially, where you've had both P3, but you've had those, and also the deal with Prologis and Nausea. So you've had a lot of that sovereign wealth kind of money coming in and making big plays. Sascha, in terms of capital, are there particular trends that you're seeing? Different types of capital coming in. US was dominant last year. Is that still the case now? Are we seeing more Middle Eastern money coming in?
I think that the trend in capital is that anyone is struggling with not enough product, but having way more capital than you can really invest. So for the first time in the history of CORESTATE, we decided to focus on some specific investor types. So for example, we now said that we don't want to host at the moment very much international institutional capital, but we first focus on German. It's way easier to handle. Communication is easier, and if you see that the pension schemes are growing and growing and growing, that in the retail sector, the open-ended retail funds, they have shut down when they talk about bringing new equity to their portfolios. So what we do at the moment is we see interest from all around the world, and we could invest with from retail to institutionals and family offices from all around the world. And we are now in a situation that we, from two angles, say, number one, we focus on German money because it's easier to handle as an investment manager, and number two, you can collect money from overall, but if you are not able to deploy it, then you're going to lose very, very interesting investor types in a very short period of time, which we do not want to do. So my statement would be that equity, as being an investment manager, equity is not at all an issue. You can choose from where you take it, and we at the moment are focusing on German institutional, and our family offices are coming from around the world, from Singapore, South Korea as well. Northern Europe, Switzerland, so basically from all around the world, and that's it.
And Martin, from your point of view, with all of this increase in capital, and obviously we saw Blackstone raise a huge fund the other day, masses of capital being raised, how difficult is it to put that capital to work in the market? And is that part of the sort of strategy for moving towards maybe some of these more alternative sectors? What's the market like to actually put that capital to work?
The fact that we are looking at alternative sectors like micro-living, student housing is just simply because we want to grow with the market. We see this as an emerging market, and we want to take a certain share. That you've been a much earlier mover in that segment, but mainly we are concentrating to deploy capital in the core segment, and we will stick to that pattern of investment. We will not move out to secondary locations, certainly not. But what is interesting is that we are seeing, in terms of capital allocation, we're seeing some markets that have a strong domestic sources of capital. Didier mentioned the SCPIs and OPCIs in France, or the SOCIMIs in Spain are another example. And some of these markets are getting ever more domestic in terms of sources of capital, and we see this as a positive sign, because that could mean that they are more protective in terms of in times of turmoil and uncertainty, because the share of French investors in the French market has risen quite tremendously. Same for Spain. There have become more national markets. Germany is becoming more international in terms of sources of capital. And the UK certainly is a good example, where you see almost exclusively foreign capital. And if you take the Asians, the Hong Kong Chinese money out of the equation, the market wouldn't look so good in London these days. So I think that more foreign money could potentially mean more volatility going forward. So that's something that we take into account. We want to take a share in, for instance, the French market and the Swedish market, because we see these as very resilient markets in terms of capital allocation. Whilst London might prove a lot more volatile, as some people would expect, and we take a very defensive approach there, looking for long income on low rent values.
And just picking up that point, Alex, in terms of the let's say the European market in general, but also the German market, although Union not moving higher up the risk curve, obviously a number of investors are moving higher up the risk curve. Do you think that that's just going to continue happening, more movement into either secondary cities, tertiary cities, or into more alternative asset classes? What's your sense of that?
So our experience is that not everybody is moving up the risk curve. We have some investors that started very early with, let's say, investing in real estate. They are at the moment, so their opinion at the moment is, let's say, staying with core, maybe core plus investments, not moving up the risk curve, just accepting lower income. But there is, at least when we look at, let's say, pension schemes that in the past invested in bonds, and bonds, that started very late with real estate or other asset classes. Let's imagine, or let's look in their portfolios. They bought in 2007 bonds and the maturity is now, so it's 10 years bonds, and they had maybe 4% or 3.5%. And what should they do with the money? And their view is, on the other side, on their liability side, they have to earn 4% something. What should they do? What we see is they go in very, let's say, cash flow intensive asset classes, like logistic, for example. They buy student housing, and let's say other more dynamic, let's call it more dynamic asset classes. And on the other hand, yes, they also like to go in locations that are not core and core plus. So we see both. On one hand, risk-averse investors stick to my strategy, accepting lower yields, and also investors that go up the risk curve because they have to. Otherwise, they have to tell their pensioners that the pension should be lower. And maybe here's maybe here's a lawyer in the room that has the pension in a pension scheme. So that's the problem they have.
So difficult to achieve. Go ahead,
Yeah, I mean, I don't know if you agree, but what we've seen over the last few years, at the beginning, we were only buying existing assets. Then we started buying developments, pre-let, fully pre-let, but buying them towards the end, so limiting the construction risk and development risk. And now more and more we buy development, which have not even started, and fully let. But now we also look at development which are partially let, so taking more risk on the lettings. And even in Paris now we buy spec developments. So that's the only way. I mean, we're actually increasing the risk curve in order to have access to the assets. So.
And that's quite interesting because that was also picked up in the Paris meeting. Alain from Affine said that they were doing that, but also converting some office into care homes, actually. Only a very small part of their business, but something that they were doing as a new thing, really. You wanted to pick up that, Jan?
Yeah, thanks. I mean, you're increasing the risk for sure, investing into developments, but if you're a pension fund, for example, you have the investment strategy that you only are allowed to invest in core, then you struggle, because I think, Sascha, you said that we have a lack in products being available, and therefore you have to find other solutions. And I just wonder, it's now just a question, because several confirmed just that the price increase will only flatten, so there will be no decrease. Was it a guarantee, kind of, or because if you're thinking, Richard, if you're thinking of the pension payments in the future, I mean, the one thing is investing in core with a very low yield, 2%, 2.5%, whatever. It's not much. You should target the 4% for sure. But what if in 10 years' time it not only flattened but prices decreased? So then you're going to hit the pension years. So what then? So is it correct only to go into core because you have to invest on a level we might have had just before 2007, and then things ran into default?
Yeah, concerning risks taken. I mean, what you really see is exactly what he says, that 2 years ago it was fully leased developments, and it's 70%, and it's now, I heard, even 40%. Is it more risk taking? Most of the parties we're talking to want us to take over development risk anyhow. Yeah, they would accept 40% pre-leased. However, we have a budget, we have to stick to it, and we have to pay cost overruns and all the stuff. So it's what I would say is that the market is getting much more flexible. That's true. But depending on whom you talk to, especially pension funds and others, they cannot simply move out of their scheme. So what you try to do is you try to meet halfway, whatever the halfway is. And I think where there's no compromises on the quality of location. So core is core, and either you are there or you're not. And then also on building quality, on releasability, all this, and on the covenant of the tenants. That's still a strong one, and seems that the possibility to get into developments on an earlier stage with all these other assurances taken is simply still a risk-averse strategy. So I would say that is what we're seeing, and from development perspective, we're able to take the development risk and take the budget risk. And so that seems to be the way to get good business for both sides. Yeah.
I fully agree with you, and I think that's a strategy for many core investors to forward fund developments and to take a letting risk selectively. Is just simply to secure a core product. And this is not moving out in the sense of accepting weaker locations or moving out into other asset classes which are higher yielding. This is just simply the only way to come by decent product. And Union, certainly, we forward funded spec development. In total, over the past 2 years, we bought 50,000 square meters of empty offices for the Unimo Deutschland Fund, the German fund, which is one of our most risk-averse vehicles. And this was only possible because the letting ratio of the fund is close to 100%. So, and the size, assets under management of more than 10 billion euros allows the fund to take that risk. And that is been the only strategy really for us to secure the product. We would, in other phases of the cycle, buy as a standing investment.
Yes, so it's the same for us. Half of our transaction volume last year was forward funding or forward purchase. But the motivation, I think, is the same. The motivation was not to generate more income. So the motivation was there, but we were not able to generate more income. It was just securing good properties in good locations. And you're absolutely right, Gigi. We first of all started with, let's say, secure cost risk and letting risk, and now we are also keen to acquire properties with at least some letting risk, so not fully not let properties, but some letting risk.
Go ahead, Sascha. Two.
Thank you. the way we handle the different risk appetites is the following. So the more opportunistic and development side of things is done with our semi-institutional investors, meaning the family offices. They are taking more risk. They are going into investment strategies like alternatives, so student housing, micro-living. They did that 5 years ago because they're taking more risk. So typically these more risky products and the development side is done with our semi-institutional one. And with them we create then the pipeline of standing assets for our more institutional, institutional clients, so that anyone is able to invest on the risk-return profile that he's interested in. And that's the way we handle the different profiles of our investors.
But does that mean that you're cross-selling between different sources of capital within your organization?
That does mean that we are offering our institutional investors to sell off standing assets that we have developed with other clients. Obviously, then the discussion is always conflict of interest. What about at arm's length? This is simply an offer. So you simply say, okay, we bought the land we developed, we took the risk, this is the pricing that our clients are offering to you, are you willing to buy it or not? And if you can come up with external valuation on that, then it's the decision of the institutional client to buy into. It's not a discretionary mandate. So we are not the ones who are...
You're not taking the final decision.
No. Not for the institutional ones. We are simply the one that are offering, and we had that discussion at the very beginning. Is that not difficult? What about conflict of interest? But actually, the way we see it at the moment is that it is covering the needs for both of the parties, and the institutional investors are very open to have that discussion.
We would love to do that, by the way, but most of the funds are managed discretionarily within the union organization, so there is no way of managing that internally.
It's quite interesting as these discussions go on, and we've been doing this for 5, 6, 7 years, that during the last 2 years there have been almost no discussion about financing. Whereas that took up almost half of sessions sometimes, and nothing on non-performing assets, how that's going to work. Jan, does that mean that all of these non-performing assets have gone through the market and are out, and there's no opportunities in that area? Is there still opportunities in there, thinking about Italy or various other places? Is that still an opportunity for investors?
It's just a question where nobody talks about it, because it really offers lots of opportunities. And you mentioned Italy. I think the banking crisis 2007, 2008, no one did anything in Italy. Yeah, and now they're catching up, and now they found out that Monte dei Paschi is bankrupt and many others there. So there are portfolios which will be for sale. And if you don't find any products, maybe it's good to have a look at that market, to buy in not via the asset, but initially via a loan. What we found out in continental Europe is that we have a different insolvency regime. So, for example, in Greek, if you have a real estate or a financing in default, and the ownership company goes bankrupt, it takes 4 to 5 years until the lender gets access to the real estate. So that's not really funny. And therefore, if we're having really poor insolvency regimes, you shouldn't touch those non-performing loans. But still, it is attractive. We did some deals last year in the Netherlands, as some banks really had to get rid of bad banks, especially get rid of their portfolios. And so we found that some investors, mainly from the US, found it rather attractive to enter into it without paying any real estate transfer tax, without paying any taxes at all, because it was structured via some offshore vehicles. They were just getting the interest and building up a compound, so cumulated interest, yeah. And so they're making huge profit, and they are riding the wave in the Netherlands currently because prices are going up. So that was the right time to invest. So yes, non-performing loans still are there, still are attractive, but you have to watch out in which insolvency regime you want to invest.
Okay, good. Let's drill down a little bit into some of the sectors. Christian, you mentioned a little bit already the drive for more e-commerce, and that's been driving a lot of the logistics development, if you like, within the market. How much further do you think that's got to go? UK obviously has, to a large, embraced it very heavily. What's happening at the moment in Germany? What's happening in the other European cities? How much further can that last?
Yeah, e-commerce, we sort of have a test environment, if you will, in Berlin. Everybody goes to Berlin and first checks out how it goes there. And then, I live in Düsseldorf, as you know, and I would like to have, order same day. But chances are that Amazon now comes around, hopefully, and hopefully some others. So we are by far not that far as in the UK. And we simply see a lot of testing going on in Berlin. And now Amazon Fresh started, and all the retail industry was like in an uproar because the prices were as low as Lidl. And so Lidl was like, oh my God, we have to, and so this all starts. However, here we see a completely new growth potential for logistics and light industrial, because, if you see alone the turnover of the food retail industry, which is, I think, above 200 billion, now imagine that 5% each year or 2% or 3% each year just goes into e-commerce and intraday delivery. It's unbelievable what still comes. And the real potential is in Germany it's called Kaufkraftbanane. It's basically from Hamburg to the Ruhr area, Düsseldorf, Cologne, Frankfurt, Stuttgart, Munich, where all the money is and where all the people are making the turnover for retail. And, we are only at the start. So given that sector perspective, also for institutional investors, we're at the start here, and I see a lot of growth potential there.
And one of the things that was picked up, especially in the UK one last week, was that change between logistics and then light industrial, which was suddenly beginning to go up in value, just because it was really people looking at it in terms of changing it from light industrial really into urban logistics.
Yeah, you have buildings like downtown Berlin, which are not really, good for logistics. But if you would tear them down, you will never ever get a industry zoning again. So you just have to take what you have and make the best out of it. And that's one of the motives for light industrial. Yeah. That's not good, really, because the rent is high and the heating costs are high, and insulation is low. And investors, of course, know it. But if you're in a downtown situation, you don't have a choice. You have to go for it. And so the other strategy basically is that you try to be at the outskirts of metropole areas, and there go into light industrial, which is more looking like logistics, giving the material flow a much better perspective, lower costs and all this, but you have to drive into the towns again. So I see that logistics and light industrial asset classes are coming together, and the investment view will and the gap will close. Yeah.
Okay, good, Sascha.
Whilst I would agree that online retail is in Germany still at the very beginning, I would argue that I'm not 100% convinced that the food sector will ever come to a kind of breakthrough when we talk about online. I just read that Amazon seems to be kind of giving up to bring the online food sector into the market, and is now working on the biggest M&A transaction they ever did, and buying into a stationary food retail. I think it's Whole Food or whatever the company names is. So what is your view on this? Do you think that online food market will really become a real online product?
I think it's all about cost and convenience. And it starts all in the big cities. Ruhr area, Düsseldorf, Cologne is one great example, Hamburg also. And it's all about getting the distribution costs down. Yeah, I mean, if you've seen bakery products, yeah, and you see now that Lidl, Aldi, and everybody is baking bread, I mean, kind of. But if you see how much bread is bought there, it's unbelievable. And what is it? It's all about the logistics cost per stop. The more you have on the truck, the better it is. And the same thing will be with online orders of food. Yeah, I mean, if you see in Berlin, it's they all have Sprinter vans, and they have 14 to 20 customers in one tour. And the main thing the customers are ordering is mineral water and Coca-Cola, because the drivers have to bring it into the 6th floor. Yeah, but this is how it goes. And if you see there, the majority of the delivery lines are positive in costs compared to the turnover, and this is the way it goes. Yeah? I mean, nobody really has currently a solution for flat white countries like Mecklenburg-Vorpommern or Niedersachsen or whatever, but in the main cities I think there is a potential, and it's just about solving logistic issues.
And let's pick up a little bit on some of the other sectors as well. Office, there was a long discussion, both actually in Paris and London, about the impact of different types of occupiers like WeWorks and those kinds of people, and so getting used to maybe a different kind of occupier client base. What's your sense, Martin, of how the office sector is developing generally, kind of some of those bigger trends that might be impacting on investment?
I think you mentioned WeWork as a recent trend across Europe. They're taking a lot of space. They're taking space in the centers where space for offices is always scarce, and they are giving the market room to breathe. In some locations, you will find major office tenant outsourcing some of its personnel into WeWork. Sometimes they see it as a think tank. Sometimes it's just space that you take for a limited amount of time in trying to reshuffle your organization into a consolidated office space somewhere else. So I think this space is needed, but it will reach a certain limit. this growth, and there are other players in the market as well. I guess what we are seeing across Germany is scarcity in the availability of office space has never been like that. I mean, I spent 2 days in Berlin this week, and it's just amazing to hear that landlords are looking at waiting lists for tenants. They're refusing tenants on the basis of, I don't want to have that industry in my multi-let building because it sort of spoils my investment profile. And we've seen that in other locations as well. Another example is the center of Stockholm, where we bought an office property recently near the main train station, and the developer was in a very strong position to let the space, had a very good tenant that would take the whole building and was only allowed to take half of it because the landlord developer wanted to have other industries in the building, wanted to have a multi-let scenario. And this is what we're seeing across some other markets as well. Berlin is an example, and Munich, where there is a very strong position. If you're in a very strong position when you're a landlord for a desirable property in a central location, and this has never been the case. And in Berlin, it's really a game changer. And also in terms of rent levels, they're reaching another plateau, if you ask me, because the city is coming into its own right as a capital city. Finally, after this is, quarter of a century has passed since reunification, but suddenly something is happening that we as Germans didn't expect, really, and the city is growing at a tremendous pace. And I believe there's been a game changer for an office market like Berlin, and this is what we're witnessing.
Very good. Alex, you want to pick that up?
Yeah, we have the same experience with Berlin. So our letting department in Berlin would be happy to have empty spaces. So there's nothing to let at the moment. Rents increased, and that's office. Office is linked to GDP growth and near to the labor market development. We have in Germany, we have a very good labor market at the moment, and I think our GDP growth above our potential. I think we have 1.7 at the moment, and the potential growth is 1.2 or something like that. So no wonder that other European countries wish Germany a little bit more inflation and let's say cool down.
Yeah, but GDP growth, I think, is one factor. The other is that in the mature markets like Sweden, like Germany, the developers have concentrated on the residential sectors for a couple of years already, and space to rent for apartments become very scarce. So the markets have moved into the residential segment because it was more profitable for developers, and these are underbuilt markets, something that we won't find in places like Poland, where the residential sector is not so strong. So this has been, I think, an effect that has boosted the office markets in countries like Germany or Sweden.
And we see less speculative development all over Europe at the moment. And in terms of office, on the other side, I think Berlin got a little bit the capital effect that we all thought would come up in the 90s. So now Berlin is the capital of Germany, and now it got really the capital of Germany. We saw some industry or some large companies that moved hundreds of employees to Berlin to establish new headquarters, and that's the development that we have in Berlin at the moment.
What you also have to consider is that we have land scarcity of zoned land in Germany in most of the places. And I was completely struck. I heard in the news that communities in Germany are in higher debt than ever before. What that means is that most of the communities don't have the money to develop new land. Yeah. So and this is what we see in logistics, especially that you have a land scarcities in the right zoning of land, and that there has to be a solution for that because communities traditionally 10 years, 15 years ago developed land by themselves and bought it cheap from the farmers and bought it very expensive. I remember one deal we made years ago in Frankfurt, where Frankfurt bought it from the farmers for €5 a square meter, and we bought it for 192. Yeah, so this is, and now it's even more expensive. And if you see why there is a scarcity in availability of development product, of investment product, that's one of the reasons, especially for the asset class in the light industrial and logistics.
We are investing in retail. We have set up a secondary city retail investment strategy for high street retail assets 2.5 years ago. We have bundled together worth €1 billion of high street retail assets. So the typical asset volume is 10 to 15 million euros. The typical inner city high street single tenant or 2-3 tenant building. We have built up that strategy again. What I said before, with our semi-institutional investors that were willing to take more risk, because actually you're buying into the same covenants. So whether you buy a CNA tenant 10 years lease in, let's call it Lüneburg, or you do it in Hamburg, it's the same tenant. But what the difference definitely is the liquidity in these secondary markets, because there was no real institutional interest for secondary markets 2 or 3 years ago. Therefore, we bought into the same building, same quality, 10 years lease CNA with a yield spread between 2.75 and 3.5% between Hamburg and Lüneburg. We were building up a 1 billion portfolio of these with our semi-institutional clients, and have recently sold 750 million euros to the Bavarian pension scheme, so one of the biggest pension schemes in Germany, and they are buying into that strategy and want to build a way bigger portfolio, because they believe that what we believe as well, that especially online retail will harm the big shopping centers tremendously. But we believe that the inner city high street retail will remain, because the inner city high streets are not only a shopping area, but are a kind of social area where people come together, and therefore we believe they are more resilient against the effects of online retail. That's more or less the strategy of that investment line.
Somebody want to stand up for shopping centres? And there's a whole trend in terms of shopping centres of creating them as a place to go. So it's a destination. It's either got to be convenience or it's got to be a destination. Is it just me?
Comment on behalf of my colleagues from the retail department. Yeah. What we are usually buying is dominant shopping centers in their markets. Many of them are located in Central and Eastern Europe, for the simple reason that the likes of Unibail, Rodamco or Klépierre would never sell their dominant shopping centers across Western Europe. So there is a scarcity of that sort of product. Weaker centers, I guess we've seen suffering, but destination shopping, like a good example is the Mall of Scandinavia, which has seen within the first 2 weeks, every 10th person living in Sweden has visited this shopping center. And it's a real... it's a lifestyle destination. People go there for many reasons, not only shopping, and it has created a whole office market of its own right surrounding it. So these integrated urban development schemes containing a large dominant shopping center, some residential properties and offices have been very strong recently.
So I'm with Martin, and you're happy. Sweden is a small country, so it's 800,000 visitors, 10% of the population.
But still,
yeah,
it's a big country.
It is, definitely. Regarding High Street, I think our task with High Street is to be very picky at the moment. We see that a lot of clothes dealers are under pressure, beside H&M and Zara, because I think everybody of you loves Zara. But there are a lot of dealers under pressure, and we saw some insolvencies. So High Street is a term is very important. Where the location is, and we invest in retail in, let's say, smaller, not shopping centers, smaller shopping ensembles, especially there where you said, well, logistic has no clue how to reach it. So not in the big cities, because we do think that that these smaller centers has a very, very important role, especially outside the big cities, because we do think it will not be possible to order bread and milk via app in, for example, let's say Greifswald. Bautzen. Yeah, thank you very much.
What's anybody's view on CE?
I just wanted to give an impression, due to political seemingly instability, Czech Republic, Poland, and everywhere, you have to explain much more if you want to go there. I mean, years ago it was a natural choice, but with government changes, there's much more reservation in these locations. I mean, I'm personally quite positive because the raw data looks good. But political instability seems to be not so funny and also harming and hindering them. Yeah.
Okay.
I think that many investors do look at the political risk critically, but a lot of investors have also learned the lessons in these markets. And referring to the office markets, we've seen the largest spreads between headline and net effective rent levels. You will find them in CE, because it's still a developer's market and tenants are being bought out of and into new developments. And we've seen this. I mean, your downside potential in reletting space at spreads of 30 to 40% between headline net effective rent levels, you need to have that in the yield. And when we are able to buy, for instance, in a secondary city that is developing extremely well, like Poznan, we are also able to secure product at 7% yield. In terms of long, in a holding period of 10 years, this will come down to 4.5 in reletting the space. And this is how the market has evolved, and this is not going to change in the near future. So we are very skeptical about, let's say, rental growth projections in these markets, but sometimes you can still secure good yields.
Same thing for logistics. So, sorry, just shortly. Spreads are much, much higher than in Germany.
So we invested over the last 3 years in Poland, I think 300 million or something like that. We see that the GDP growth in Poland is absolutely on the top of all European countries. We have a very, very, very well educated population there. For sure, we also see that office in Warsaw with short letting or walls is not the best idea at the moment. So we also see a lot of construction, at least in Warsaw, but in the, let's say, so-called Big Five or B cities in Poland, we see a good chance to invest also in office and also in retail properties. But that is where CEE ends. So CEE at the moment is not Czech Republic for us. It's not Slovakia, and it's not Hungary.
I totally agree on the macro fundamentals for Poland, and I would be interested to have a closer look, or we had a closer look at this, especially for our micro living segments in the bigger cities there. Very interesting, but our general view on this is that the more challenging the markets are, and I think we all agree that Poland is a challenging market, the more we would only go and invest there alongside an M&A transaction, so where we can take over a local team, because we don't feel comfortable enough to have the knowledge, the deep inside knowledge of the Poland market, managing from Frankfurt Central District. That's our view, and we have not found the right partner so far.
In terms of takeaways, I'd like to ask you all, where should we invest? So where ought we to invest? That can be, you can choose whether it's Germany, you can choose whether it's across Europe. And as a second one, because we did our deal of the decade this year, and we're going to do deal of the year next year, is there already something in Europe or in Germany, or a deal that you've done that you think should be the deal of the year already in the first half of the year? Let's start with you, Didier.
Yes, I think that our acquisition in the Atrium in Amsterdam should be at least on the top of the list.
It's a very good. That's a very good deal, actually. Yes, but where should people invest in general? What's your tips for?
You know, actually, what we do at the moment is to check on all the market what we can find. That's I can't say it's better to invest in Germany or in France, or it's really a question of on a deal by deal basis, basically. We check around, and whenever we find the right one, we try to get it.
Yeah, he's not going to tell us, is he? That's the Christian.
Yeah, I think the problem is availability of product, and so it's not what you would like to, where you would like to invest, or it's just where you get some. Deal of the century, at least for logistics, is the Logicore sale, I would think, because it puts us on the map of almost everybody in the investment community. I mean, a 12 billion deal we have never seen before, to my recollection, for logistics. And it shows that it's now a truly global asset class. And so that would be my recommendation.
Okay, good. Jan.
Yeah, I mean, it all depends on the investment profile, yeah? What is the investment strategy you have? And then you could tell where to invest maybe. But
Are we feeling risky today? Are we feeling more? Yes, yeah, we're feeling quite risky today. We're happy to take on risk. We've got bold investors, Jan.
okay, Mallorca, how about that? Spain is coming back, so I wouldn't go for Mallorca, but I think Spain might be pretty attractive for risk investors.
Okay, good. Alex?
So we don't apply for the deal of the year. Because we just buy, let's say, most kindly popular properties are not in any case the properties that have the very best turnover. But how to invest or where to invest, yeah, for us the pan-European strategy makes sense. To my mind, Germany is a very good location to invest at the moment. We have a very good environment, and to my mind, when the black swan will come up, each market will get its hit. So diversification is, and also diversification in asset classes or use types might make sense.
Okay, good. Sascha?
Well, the most important deals that it's always difficult, and not as we have been involved in, but maybe that gives us an outlook on some trends to the future are the two main transactions that the Bavarian pension scheme I mentioned before did. This is number one, the secondary high street retail, so showing us that the big pension schemes are going into secondary cities as a lack of product is occurring. And they also invested $250 million into student accommodation, which is a second trend that we discussed today. This is a second trend that became kind of institutional. So I would choose these two deals as maybe showing the future of some of the products that we have been discussing today. And where would I personally invest? I like to invest in mega trends, and I think education, especially in Europe, is one of the mega trends. So, the let's say the movements from the people that are on work, living in one space but have to work in another space. So these are the two mega trends that I would invest in. That brings us then to micro living across the big European countries, where I would prefer Germany and Spain at the moment.
Great, Martin.
I guess we will continue and stick to our investment rationale to allocate the majority of our capital in Western European core markets. And it boils down to the individual product. So we are opportunity driven in the sense that if we find the right product, we will always like to buy it. And the current liquidity in many markets unlocks product that we haven't seen for years in a row, because some quality product is only being sold at really the top of a cycle, and these opportunities are very tempting, but they're also expensive. And I guess when it comes to risk-taking and overpaying, the deal of the year might well be the one that you didn't do in hindsight.
Okay, all right, interesting, very good.